Hey guys, welcome back to another video. I hope you guys are having a good week negotiating with those brokers, keeping your trucks rolling for a good rate per mile and keeping in those good, relatively good markets. As for me, it has been another challenging week from a broker hanging up on me twice because I tried to negotiate a higher rate per mile, to a slight downturn in the flatbed market, and to basically losing my cool and using several people who cold called me as my personal scapegoats. Definitely a week of losing my patience, taking my anger out on poor telemarketers, whatnot. But anyway, today we're going to do another market update and forecast video. What happened in the market, what to expect next week. And if you're new to my channel, welcome. I teach about the trucking industry with a heavy focus on the spot market as well as freight market analysis. So if this is a topic that interests you, feel free to subscribe down below. All right, let's take a look at what is going on in the trucking industry. Ready? Let's go. Now, before we go to the board, I will be live this Sunday at 4:30 p.m. Eastern answering questions about the trucking market, the industry in general. So if you have any questions, you know where to find me. Okay, let's go ahead and look at some data. All right, let's start with the outbound tender volumes versus tender rejections. Volumes are in blue, rejections are in white. As a reminder, volumes show us how much freight there is in the market, while tender rejections kind of give us an idea of capacity. This is contract freight that is being rejected and therefore pushed to the spot market. So what we can see right now, right here, is that volumes have been going down since the 16th and tender rejections are going up, which is good. Currently, tender rejections are at 2.79%. Now, a few days ago, if you look right here, they were at the lowest point in 5 years. And part of the reason that tender rejections are probably going up is because of the DOT inspection week. So a lot of carriers, they actually park their trucks and they do not operate during this week. So this is probably what's happening. Now, another thing I want to mention is that tender rejections often follow volume patterns with a slight delay. If you take a look right here, volumes went up right here, tender rejections went up right here. Then there was a decrease, increase. You can see it. So what we can see from this right here, this resulted partially because the volumes dropped. And now this is also following the pattern of the volume here. Now, considering that volume is on its way down, we can expect that most likely tender rejections will also go down in the next couple of days, maybe a week or so, hopefully not to this level, but nevertheless. Then we have the National Truckload Index for line haul only. Again, this is based on dry van data, and this is spot rates with the exclusion of fuel surcharge. Currently, the average spot rate for dry vans is $1.53 per mile. Now, it is an increase from the low right here, probably because of the increase in tender rejections. Spot rates and tender rejections follow the same pattern as well, but this is a very low rate per mile for the spot market. Then we have the spot to contract spread. How much more are contract rates paying than the spot market? And we can see currently there is an 87 cent per mile difference. Spot rates pay on average 87 cents less per mile than contract rates. Now, it is a decrease from last week, but again, this is probably because that spot rate went up because the tender rejections went up. Finally, we have this chart by FTR. And by the way, again, I'm going to include all of these charts down below so you can download them. These are the total spot loads for all equipment types. And you can see this bar graph. This is the current year, 2023. 2022 is the orange. 2021 is the green, and the dotted line is the 5-year average. So you can see that the volume on the spot market is not only below 2021 and 2022 levels, it's also below the 5-year average. Now, I keep on saying that volumes are holding steady. So I'm sure you're wondering what gives. You said that volumes are holding steady. How come it's lower than the 5-year average? Because most of those volumes, they go to contract carriers. They don't end up on the spot market because those tender rejections are super low. So the spot market volume is actually lower than the 5-year average, which is part of the problem. All right, now let's get into specifics by equipment type, and we're going to start with flatbeds, starting with the volume on the spot market for flatbeds. Now, as you can see, this is current year. Flatbed volumes on the spot market are below the 5-year average and definitely below 2022 and 2021 levels. So less loads to choose from, and partially, of course, this is because a ton of that volume is getting soaked up by the contract market. Now, if we look at flatbed spot rates, same principle applies. This is current year, then the green is 2021. The orange is 2022, and the dotted line is the 5-year average. Flatbed spot rates are above the 5-year average, but definitely below the 2021 and 2022 levels. Now, if we look closely, they have been slowly climbing and now are on their way down. So yeah, the flatbed market is also struggling, and I'm actually going to show you an analysis. I crunched some numbers here just to show you what is going on with flatbeds. But before we do that, let's take a look at the best places to be if you have a flatbed. This is from truck stop data. Now, this is showing us how many outbound loads there are, and we're only looking at the flatbed column versus how many trucks are coming into that state. So this is the southern states, and I actually highlighted the states where there are more outbound loads than inbound trucks. Alabama, Arkansas, Georgia, Louisiana, Mississippi, and South Carolina. If we look at the northeastern states, we can see Delaware, Maryland, and Maine are the 3 places this week where there are more loads going out than trucks dropping off in those areas. As for the plain states, usually everything is oversaturated with capacity, so there's not a single state here where there are more loads than trucks. Then we have the Midwestern states. The only states which has more loads than trucks is Illinois, right here. And then the Western states, California, Idaho, Oregon, and Washington. Now, again, as a reminder, does this mean that California or Oregon or Washington is a good place to be? No, but it's a good place to be if you're looking to just stick to the West Coast. But remember, the fuel prices there are ridiculous. Now, let me show you some data that I crunched using these numbers over a period of time. Every time I release a video, I show you these flatbed numbers. So I use those numbers to show you what is going on in the market. Okay, let me explain. Number one, we have the total East Coast. I'm just taking the areas and combining all the loads. So for example, I would just take all the flatbed loads here and make a sum, right? The total. So this is what I'm doing for each area. The blue line is the amount of loads, outbound loads, March 30th, April 6th, April 21st, April 27th, May 12th, and today. This reddish pink line is capacity, how many trucks are in those areas, right? For the same time. Now, a few things I want to let you know. This data is not 100% accurate because this is loadboard data. So the volume, as we all know, brokers tend to repost the same load over and over and over again, increasing the volume. On the East Coast, volumes really increased as of today. Before they were they increased, but they're under 7,000 total in the East Coast. The number of trucks, they also increased, and there is overcapacity. As you can see, the red line is higher than the blue lines, which means there is overcapacity. There is no negotiating power in the Northeast in general. Let's take a look at the South. Now, these arrows means that there is severe undercapacity. It means there are definitely not enough trucks, so much so that it's off the chart. So we can see in terms of volumes, May 12th was strange. There was a severe lack of volume, but nevertheless, there is a lack of capacity in the South. Let's take a look at the plain states. So these red arrows means that overcapacity is so high, there's so many more trucks than loads that it's off the chart. The only one where it's in the chart, still overcapacity, is right here on May 12th. But we can see that volumes in the plain states have been declining, although today they have increased a little bit. But overcapacity galore. Now, West Coast, we can see that in March, and we're taking all West Coast states, we can see that volumes have been gradually increasing in the West Coast. We can also see that the amount of trucks have been gradually increasing as well. Now, if you look closely, if you can see that there is no overcapacity in the West Coast, right? It's below the amount of loads. But again, remember, this is based on load board data, so it's not 100% accurate. As for the Midwest, we can see that load volumes are kind of all over the place. Something happened on May 12th. I don't know what it is. There was just a lack of volume that day, but we can see that currently there is a huge overcapacity of trucks in the Midwest. The only time there was no overcapacity was around March 30th. Now, just to show you, I also have this chart. This just shows us the capacity in each area. In the Northeast, we can see that the capacity was increasing, it dropped, and now it's higher than even on April 27th. So capacity, the amount of trucks increased. In the South, the capacity, the amount of trucks increased since May 12th. In the Plain States, there was pretty much a decrease in trucks, except for today. Now there is an increase. Then we have the West Coast, steady increase in the amount of trucks there, probably because there are also more loads there. And then finally Midwest. Yeah, Midwest has overcapacity. It's kind of all over the place. It increases, it decreases, and now it kind of shot up into the stratosphere. So I thought it was important for you to know what is going on based on data and to see how the market is changing for flatbeds as well. Then we have this map that I show every week, and this shows us, again, capacity versus loads. The darker an area, the more negotiating power, because there are less trucks going into that area than there are loads coming out. And again, the South is good. Certain areas in the West and Maine. Look at Maine. I don't know what happened there, but Maine has definitely less trucks than there are loads. Okay, now on to the dry van, starting with the load volume on the spot market. And we can see, again, we are below the 5-year average. There's just not much volume making it to the spot market because contract carriers are soaking up everything. If we look at the spot rates, we are below the 5-year average, and we're kind of going down and down. Currently, the average is like $1.76, $1.80, something like that with fuel surcharge. So very low for dry vans. Now let's take a look at what is going on with total volumes, not just the one that ends up on the spot market, right? So here we have volumes. The height of an area shows general volume in that market. The higher it is, the more volume. If it's red, that means the volume decreased from last week. If it's blue, the volume increased. Gray usually means no significant change. For the most part, the map is gray. There are some increases right here in Texas. Basically in the South, there are some increases. Maine, New York, the West Coast, for the most part, not much happening, but nothing exciting with volumes going on. What about tender rejections? If we look at tender rejections, as a reminder, this map works the same exact way. The higher the market area, the more tender rejections happen there. If it's blue, they increased from last week. Red, they decreased from last week. And for the dry van, we can see the North Platte market increased, and it's pretty high. There is a lot of tender rejections happening here. But if we look at the volume is pretty low. There's no volume. So even though there's more freight getting rejected, there's not much on the load board to choose from. Then we have Minnesota, we have Montana, the Lubbock, Texas area, some random places, but we can see that there are a lot of red places or white gray places, which means either no change or a decrease in tender rejections. So we're still waiting for the market to get better. Currently, it is not there yet. If we look at the head haul index, which shows us how many trucks are going into an area versus how many loads are going out. Red means more trucks than loads. Blue means more loads than trucks. We can see that on the western portion of the US, there is overcapacity. It's starting to get a little bit better in the southeast. Tennessee, Georgia, Alabama, South Carolina, Ohio, Harrisburg, Pennsylvania, right? There's a little bit more negotiating power, and a sliver of California right here. But in general, overcapacity. So where do you have to go if you're a dry van operator, if you're looking for a better place relatively? Remember, you're not going to get $3 per mile on a dry van, but relative to the rest of the market. Well, here's a map. The height shows us the volumes, how much total volume, contract and spot there is versus tender rejections. If a place is more blue, there are more tender rejections. So an ideal place is where the volumes are high and it's extremely blue because a ton of that freight is getting pushed into the spot market. Now, North Platte, Nebraska, it's very blue, but there's no volume there, so not much to choose from. Then we have Wisconsin. Right here, there's a little bit more volume, maybe a better place for dry vans. In general, though, I can see that it's the Midwest and the South. The South looks like it's a little bit better, especially the Houston area. Although there's also some promise in Maryland and Delaware. Louisville, Kentucky is back on the radar, which is nice. If we still had a dry van, I would probably be operating in Texas, the Midwest, Indiana, Ohio. I probably would not be going to the East Coast right here, even though it looks promising because everyone's deadheading there. So I would stay away from that. The South is interesting, but there's not a ton of volume. So yeah, Midwest and Texas is where I would stay. All right, now let's do the same thing for reefers. First, we look at the volume on the spot market, and we can see that again, it's way below the 5-year average. Not much to choose from on the load board, unfortunately. Everything is getting soaked up by contracts. If we look at the spot rates, again, we are below the 5-year average. Looked promising for a few weeks there, but now we're back down. So yeah, it's not ideal for reefers either. So let's take a look at total volume for reefers. And again, as a reminder, height shows general volume, spot and contract, whereas the color shows us change. For the most part, we can see no change in volume. A ton of flat places, not much volume. In the Midwest, it looks like volumes dropped. Utah, Idaho, volumes dropped. Southern California looks like the volumes are picking up. Maybe produce season is starting. We can see that there's a little bit more promise in terms of volumes on the eastern portion. Tennessee, South Carolina, Georgia, even Jacksonville, Florida, Pennsylvania, Massachusetts, there were volume increases. But in general, there's an issue with volume, I would say. Now, if we look at tender rejections, works the same way, we can see it's a little bit more interesting. I still really like the Pendleton, Oregon market. As you can see, ton of tender rejections relatively, and they increased. Looks like the Fort Worth area came alive a little bit. The Northeast, especially the Buffalo, New York area, and looks like Vermont as well. Virginia, Illinois, although most of the Midwest had a decrease in tender rejections. But yeah, I still, I like the Pendleton, Oregon market, which includes Yakima, Grandview, Washington, some produce coming out of there. So at least that market is promising. The rest of it is, well, it leaves much to be desired. So let's take a look at the head haul index for reefers. As always, not as bad as for dry vans, a little bit more spread out. It looks like in the Midwest, some of the Midwest, there are more loads than trucks. California, definitely. The Fort Worth area. The Pendleton, Oregon market is okay, but Portland, Oregon, Seattle, Washington, overcapacity. Arizona, overcapacity with the exception of the Nogales area. Yeah, not as dire as for the dry van, but definitely far from ideal. So where do you have to go if you have a reefer? So again, what we want to see is we want to see elevated market area, because that means there's a ton of volume, and as blue as possible, because it means that the rejection is high and therefore a ton of volume is going to the spot market relatively. So the two market areas that I like are the Pendleton, Oregon area and the Fort Worth, Texas area. The Midwest is okay, relatively better than the South or the Northeast. But if it was me, I would be running from the Pendleton, Oregon area, Yakima, Grandview, Washington, to Fort Worth, and back, sometimes maybe hitting the Midwest. This is the best chance you're going to get. Doesn't mean you're going to get an insane rate per mile. It just means that you're going to get a better rate per mile than if you went somewhere like Ohio. Okay, finally we have diesel prices, and they did go down, although they are on their way up again. So this is the diesel truck stop actual price per gallon, and they are on their way up, but very slowly and kind of plateauing. Currently, on average, we are at $4.07 per gallon. Just yesterday, I don't remember where it was. I think it was in Tennessee. I'm not sure. I finally saw a refueling station on my RTS system that was under $3. It was $2.96 or something. I was so excited. But yeah, diesel prices have gone down, kind of plateauing now. If we look at this, we can see for the most part it's red, which means there were a lot of places where diesel continued to decrease. Now there's also some green: Minnesota, Montana, Utah, Wyoming. Those are the places where diesel prices increased significantly. Oh, also Fort Worth increased by 0.3%. But in general, I mean, I'm not extremely excited about the prices of diesel, but at least they were going down, and hopefully they continue going down. Honestly, there's not much to say here, is there? On one hand, volumes are strong if we're looking at all volumes, right? Contract and spot. There was a little bit of a downturn this week, but in general, volumes are where they should be. The problem is that those volumes are mostly going to contract carriers, right? These are mostly contract volumes, which means that the volume on the spot market, as we saw, is very, very low for all equipment types. And then, of course, there's an issue of too many trucks in the market, both on the contract side and especially on the spot side. Now, according to FreightWaves, and I'm going to read this, so far in 2023, FreightWaves has reported only 7 bankruptcies, a little more than 1 a month. The worst trucking market prior to the current one was in 2019, the trucking bloodbath. At one point, FreightWaves reported 10 trucking bankruptcies in a single week back in 2019. Now, FreightWaves continues to argue that possibly this is because of how good and lush 2021 was. And many carriers, like they should have, they saved up money, right? And this allows them to operate at a loss sometimes in the current massive downturn. So that means we won't see as many bankruptcies as we would expect in the given situation, because those carriers have a good cushion. And it's going to take some time for them to actually start losing money in a significant way where it starts affecting their operations. Now, at one point this week, tender rejections were at their lowest point in 5 years, and I was in such shock because I check Sonar every single day, especially tender rejections. They give me an idea of what's going on in the spot market. Tender rejections were at 2.53%. This is the lowest point in 5 years. It scared me. Since then, tender rejections did climb up, but partially this is because of the DOT inspection week, right? Many carriers, they do park their trucks and they do not operate during this time. But to be quite honest, I did not feel a change in load prices or capacity this week. So it was pretty much business as usual, unfortunately. Anyway, guys, I know that the market and the economy in general, it's depressing, but that does not mean that we have to be depressed with it, as tempting as it might be. I try to remind myself that yes, currently I'm swimming against the current. I am tired, I'm exhausted. Sometimes I'm swimming in circles. Sometimes I feel it would be easier to just drown and say sayonara, but I know that if I hold on long enough, the current will change and I will be stronger from battling against the current for so long. Keep your chins up, keep moving forward, even if the end result is you ending up in the same place that you started, because I understand it's 2 steps forward, 1 step back, sometimes 4 steps back, whatnot. But the goal is to keep on moving forward. Anyway, wishing you guys a wonderful weekend, and I will see some of you, maybe all of you, in the live on Sunday at 4:30 Eastern. See you guys then.